All right, testing 1, 2, 3.
All right, good morning. It is now 8 o'clock.
Recording in progress.
And we'll go ahead and call to order the Real Assets Committee here, Real Estate and Real Assets. Can you go ahead and do the roll for us?
Thank you, Mr. Jones. This meeting is being conducted as a virtual meeting and in person. 1 second. I will do a roll call of the trustees to confirm attendance. Mr. Jones?
Here.
Mr. Kelly is not here. Mr. Green, Jason Green? Mr. Knox?
Good morning, I'm here.
Thank you. Mr. Santos?
Present.
Ms. Sanchez?
Here.
Mrs. Jones, not here. Mr. Green?
Here.
Thank you. Mr. Rue? Not here. Staff participating in the meeting include the following: CIO John Grable, CEO Santos Craman, Chief Counsel Stephen Wright, Investment Staff Jim Rice, Tara Elijah, Daniel Joey, and Pushpam Jain. We have consultants Alborn and Makita on site. Trustees, please use the raise your hand option to be placed in the queue. At this time, we ask all meeting participants to mute their mic until you're ready to speak, and now we may proceed with the agenda.
Okay. Yes.
Am I voting?
Yes, you are.
Yes.
Okay. Thank you.
We're in the queue. Thank you. Do you need to read the teleconference?
So we do have Mr. Well, he's not on site right now, but Mr. Jason Green will be joining in virtually, but he's not participating as of yet.
Oh, this is not okay.
Yeah.
Got it. All right. And then, all right. So then, as it relates to the approval of the minutes, did we have any responses to at all?
Second.
Another great, awesome. Cool.
Okay. Mr. Jones.
Aye.
Mr. Kelly's not here. Mr. Green's not here. Mr. Knox.
Aye.
Okay, and Mr. Santos.
Here. Yes.
Okay, the motion passes unanimously.
All right, Linda, did we have any public comments?
We do not.
All right, then I think, Jim, you probably need to sex up the content more so we'll get more public comments into here. I can't believe that we don't have people that are clamoring to get in there. Yeah, exactly. All right.
Be careful what you wish for.
Exactly. With that being said, we'll move on to our non-consent item and the real assets structure review, which is obviously the main entree for today's meeting. So, thank you.
All right. Thank you. All right. Good morning, Mr. Chair and other trustees. This presentation is the first of 2 structure reviews that are being conducted in the real assets category. As a category is called real assets and inflation hedges. It's one of our 4 risk categories. On this slide, we show that this represents 17% of our total fund. And of that amount, currently 5% is in core real estate. It's actually a 6% strategic allocation to core. Real estate's going to be covered, both core and non-core real estate's going to be covered in a separate structure review that at the committee meeting in February. So the focus today is on the other 3 subcategories in this risk category, which include infrastructure, natural resources and commodities, and TIPS. On the next slide, we summarize the 4 key subcategories in real assets. All are intended to contribute to the total fund in 3 main dimensions. One is providing a source of returns that are different from the equity returns that the risk of which tends to dominate our total fund. Next is having a source of return that's generated from income rather than capital appreciation. And then lastly, the dimension is that we want these assets to have an element of inflation hedging in our portfolio that responds positively when we experience unanticipated inflation. On the next slide, we show another way of viewing the real assets category. Another way of looking at it is like credit. It sits in the middle of our risk return spectrum of the 4 key risk categories in our portfolio. Real assets are intended to provide they aren't intended to provide the highest returns in our portfolio. We look to growth assets for that, but really we look for these assets to provide a more diversified sources of return that aren't as correlated with growth assets when those assets aren't doing as well.
Real estate fulfilling that, at this point?
Well, I would say we can cover that in the next one, but it did do it earlier maybe in this cycle where we saw lower equity returns. Real estate did stand up, but now where we're seeing higher equity returns, real estate is not participating in that. So I think it's still a diversifier. All right, moving on to the next slide. Here we outline the path we've taken in our real assets category. The whole category was created in 2018 as a result of the strategic asset allocation that was conducted that year. The goal since then has been to create a portfolio of private assets that we would be investing in over time in the areas of infrastructure and natural resources, and keep a passive exposure to TIPS. We did update our asset allocation in 2021, where we added the strategic allocation to infrastructure to 5%. And as part of these structure reviews that we've been doing every 2 years, we've implemented some guidelines that have been approved by the board and the committee. And today's structure review includes three proposed changes. One of which is there is a slight refinement of some of the guidelines that we have in place. We've put in place, or we're proposing, emerging market guidelines. And then lastly, we're including the public market guidelines for the first time in the structure review. Though they've already been in place since we've had this asset category. Moving on to the next slide. Here we describe some of the environmental, social, and governance financial considerations that are in front and center in the investments we consider in real assets, particularly in infrastructure and natural resources. We've listed here some of the ways that we consider these factors when we're considering making a new investment or in monitoring our existing investments. Some of the newer aspects for ESG in this structure review include the responsible contractor policy that was adopted. Some changes were adopted in the past year, rolling that out and implementing that in this part of real assets, as well as incorporating more climate-related data to help us better understand the financial risks and opportunities that exists in this category.
The responsible contract policy?
Well, we're just now rolling it out to the real asset managers. So I think we expect some of them to have them already, but I think it hasn't been as widely adopted in the non-real estate part of real assets. But I think we'll see. I think we've seen this in doing some diligence in managers. There are a few that have them, but I don't think it's as widely used in real assets.
Thank you.
All right. This next slide is one that we've added to the deck here in the structure reviews. We're summarizing some of the key preferences that exist in the real asset category that we really consider when we're making an investment in this space. This is a new slide in the structure review, and our staff will be using a similar exhibit in all of the asset category structure reviews that you'll see going forward. What we're trying to do here is just hit on some of the unique aspects of what we're targeting in the real asset category. We've already mentioned the key three objectives of diversification, yield, and inflation hedging. An example of how we're trying to achieve diversification in the total fund. We're investing in assets that we think are less dependent on GDP growth. Generally, when GDP growth is high, equities tend to do well. But we also look for assets that have contracted revenues with reliable counterparties. So that provides, a more stable source of return that's less dependent on GDP. In terms of yield, we recognize there's there could be a trade-off between investing in assets that generate a return from capital appreciation versus yield, but we want to be conscious of having at least part of our mix of returns from this category, including a yield component. In terms of maintaining market exposure, we've created our public portfolio that includes what we call our completion portfolio. As we're making this transition to private assets, we want to make sure that we're diversified by by vintage year, so that we're keeping a steady deployment and that we're taking advantage of opportunities that arise across vintage years. Excuse me. In terms of the focus on fees, as we're creating a newer portfolio, there are opportunities for us to get into some of these assets at a lower fee entry point. We've done that through open-ended core funds that generally have lower fees than closed-ended structures. Thank you. And being an anchor investor in 2 of the 3 core funds that we've invested in have enabled us to get more attractive terms than those that are available to new investors or to investors that would come in now. We expect co-invests to be a source of either low or no cost fees. And we've brought it also in the farmland space. We've done a significant secondary purchase that's enabled us to construct an intentional portfolio that's been done at a discount to NAV that's been additive to our returns. The next category of just in terms of what we're exposed to in the energy transition that's occurring, this is what's going on in the broader economy. There's a movement away from fossil fuels as an energy source to more of a focus on low carbon or renewable sources of energy. In our portfolio, that takes on 2 dimensions. We want to make sure we're avoiding being exposed to stranded asset risk like we've seen with coal in the past few years. But we also think this is a developing area for new investment opportunities to participate in. Yes.
Would that last point be mostly domestic?
No, I would say it's a global. This portfolio tends to be focused on more developed markets, so Europe, Asia, developed markets in Europe, Asia, and the U.S. or in North America. So we see that across, in North America and Europe especially.
And there's no target balance between domestic and international. Just
we'll get into that when we discuss both the natural resource and infrastructure components, what the ranges are. Moving on to the next category, we have another just view of on the next slide 10. As an investment organization, we have 5 key pillars of strategic initiatives that we often discuss as a team. What we're doing in real assets is consistent with these 5 pillars. We show those on the bottom of this slide. On the next slide, we're just highlighting the various degrees of complexity in our structure and how we're using our private assets to push into more complex structures that we think are providing either more intentional portfolios or better returning opportunities, like in co-invest or in club deals like we see in farmland. So at this point, I'm going to turn it over to Tara. She's going to cover both the public market structure as well as the performance of the real assets program.
Thanks, Jim. Good morning, Chair and trustees of the committee. On the next 2 slides, the transition from public real assets to private real assets is shown. Currently, the allocation is approximately half public and half private, and the portfolio is expected to have a full private allocation in the next around 2027 or in the next 3 to 5 years. So the real assets category was created in 2018, and that approval was a private portfolio. So as part of implementing the allocation, a completion portfolio was built to gain exposure to infrastructure and natural resources in the public markets to maintain the policy exposure while we ramp up the private piece of the portfolio, because it takes time to source those deals and deploy capital in the private portfolio. The graphs on the bottom show the allocation over time to public versus private, with natural resources and commodities on the left chart and infrastructure on the right. The private allocation is shown in the same blue color on the bottom of both charts. And you can see starting around 2020, 2022 to 2023, you see that blue increasing, which is the private piece of the portfolio. And the dotted line shows the policy target for both pieces of the portfolio. The next couple of slides get into the performance of real assets ex real estate. So on this slide, you'll see at the total portfolio level, the category has outperformed the benchmark in all periods shown here, which are year to date, 1 year, 3 year, and also since inception.
So can you go back a little bit?
Yes.
So this chart reflects the performance of the portfolio subsequent to the changes that were made in terms of going away from separate accounts into commingled funds.
Oh, no. So this shows real assets, so infrastructure and natural resources, and it excludes real estate.
Gotcha. Okay,
Yes.
that's
Yes.
all right.
Good question. Thank you. So on this, sorry about that. So on this slide, infrastructure and natural resources are broken apart into the public and private components to show the performance. And then another public piece of the portfolio is our treasuries portfolio, or TIPS. And so focusing in on the public side, first, public infrastructure has outperformed since inception, but has met or underperformed in the recent periods, whereas public natural resources and commodities has also had some underperformance since inception, which is in 2019. But the managers overall have been performing very well. And now shifting into the private components, private infrastructure began investing in 2020. And as we build out the portfolio, it has been subject to J-curve effect. And so to try to mitigate that, we invest in open-ended core funds. And we expect more steady returns versus public markets as the portfolio matures over time. Private natural resources does have a legacy investment that was a drag on our since inception performance, but in recent private investments have shown positive returns and have outperformed the benchmark. And the TIPS portfolio has hugged the benchmark, which has met expectations. So the next slide shows forecast active risk for real assets ex real estate. And currently for Q3 of 23, it's at 4.9%. And when we break that down into allocation and selection, allocation, which is shows against the benchmark where we are with weightings, makes up a very small portion since we are close to target in all the different categories. For selection, which is our manager selection, the majority of the active risk is coming from infrastructure at 3.8%, and the remaining is from natural resources. On the bottom, you will see a large portion of the portfolio risk that comes from equity factors, and that's driven primarily by the investments in the public markets in the completion portfolio that I mentioned previously. And now I'm going to turn the presentation over to Daniel Joy, and he's going to cover the infrastructure section.
You're going to do it in French?
Sure.
Thank you, sir. I just wanted to brag about the fact that several of you speak different languages. We got Portuguese and Spanish, and I can go on. But anyway,
it might be easier for me.
Actually, Daniel, a quick question, or I had a question actually before you proceed. In terms of the transition from public to private, in terms of the makeup of our emphasis here, does the nature of our capability from a staff, technology, data, process, are we there and we're just kind of layering this transition kind of onto that, or are there additional investments that we'll need to make internally as the portfolio begins to take more of a private makeup versus a public makeup?
Probably more of a
Yeah.
Jim question.
I mean, I think we're, oh, can you turn my mic on? Sorry, thanks. We're one of the few teams that has both a public and private element to what we're doing. But I think, we're well equipped. What we're doing in the public markets is very similar to what the rest of the team is doing in other public market portfolios. So we have all the processes in place to help us, manage public portfolios. And then, for privates, that's really the focus. A lot of the emphasis of what we're doing is on the private side, underwriting new funds and, understanding the space and, who's offering what. So, I would say more of the focus is probably on the private investing, but we do have an element of managing the public portfolio as well.
So my question was mostly about the transition to private. Did you feel like as we make this and you look at what 2027 looks like, is there a component of that that includes, I don't know, additional data sets or talent enhancement from some of the team in terms of the exposures they get? Just curious about whether this movement impacts our makeup at all or not. It may not, but
I think we're well equipped right now to handle what we're doing in this space. So I don't think there's a big gap that we're trying to fill.
Yeah, and along those lines as well, we do have the private markets data provider that we're gonna doing an RFP for currently. So we're continuing to roll out more tools to help us, with the private piece of the portfolio.
Good morning, Chair and Trustees. I'm going to talk about the private infrastructure strategy and our proposals and changes that we're proposing to the board. Moving on to the next slide. So as we mentioned, beyond the real assets mandate that all of our asset categories have, infrastructure is essentially a little bit less risky than what you would see in private equity. So it's a dampener sort of to the portfolio. In terms of, so the main takeaway here is that one, we've changed from last time the expectations on the returns, and that comes from the increase in interest rates. It'll have escaped no one that the Fed has hiked quite a bit, but valuations so far haven't really reacted to that, and they're still quite high. So our expected returns have come down a little bit going forward. In terms of the core and non-core split, we haven't changed anything. The ranges haven't changed. And the sectors that we're targeting are still the same ones. Energy, which is mainly power generation, whether that's renewables, wind and solar, or conventional, more natural gas, energy service district heating, or water and typical utilities. On the telecom side, nothing's changed. Cell towers, data centers, fiber to the home type of investments. Transportation is all about ports, toll roads, and bridges. And then finally, social is mainly availability-based payments around buildings, typically hospitals, universities, and government buildings. Moving on to the slide here around geographies and sectors. So on the top left, you'll see in the blue line is where we currently are in terms of our private infrastructure deployment into the different sectors. And the gray rectangle is the range that we're proposing. And I'll come to that in a little bit because there's some that have stayed the same, some that have changed. And on the right side, you see the geographies. On the proposed changes, we proposed widening a little bit the ranges around energy and telecom. And that's mainly due to the fact that we're seeing more opportunities in these sectors than in other sectors. And it's also, after doing a little bit of work on it, we see them to be more sensitive to our benchmark. Our benchmark, sorry, is more sensitive to them than the other parts of the portfolio. Other than that, the geography and the other sectors haven't changed. And we're not proposing any other further changes. As you know, we're currently targeting 5% for the infrastructure allocation. That may change over the course of the year as we're working on the strategic asset allocation. On the bottom left, you can see the split between core and non-core assets, or what our plan is in terms of, or projections are in terms of deployment of those two buckets. We're planning to reach roughly, once we hit the run rate sort of over the long term, a 60-40 split. Over the near term, we've deployed more into core funds over non-core funds. mainly due to the fact that core funds deploy faster and they give us more flexibility because they're typically open-ended funds where we can get quarterly or semi-annual liquidity, which means later on, as the program develops, if we need to rebalance, it gives us more flexibility. And I'll pass it to Pushpa.
Thanks, Daniel. Good morning, Chair, Committee Chair, and Trustees. I'll walk through the natural resources segment within real assets, ex-real estate. So on slide 23, we kind of lay out the role and objectives. There are three components or subsegments within natural resources. Energy, which I'll walk through kind of the detailed components of energy, mining, and then agriculture and farmland. And similar to other segments, as Tara outlined, as infrastructure, we also have a transition from public to private within the natural resources segment as well. So what are the different, on slide 24, what are the different components within here? And this also kind of lays out the dimension of public to private transition. The portfolio currently is targeted at 3% for natural resources, and then approximately half split on the public side and half on the private side. On the public side, we are invested in natural resources public equities, and then we are invested in commodities futures. On the private side, the opportunities that we have targeted are energy transition and then agriculture and farmland. So within agriculture, we consider agribusiness PE funds as part of this segment, and then also mining funds that are part of this segment. And the changes being proposed here are simply as we've built up the portfolio, we've moved the ranges from 0 to 70% to 15 to 70%, as there is some component segment built out already in the private sector portfolio.
Quick question, Mr. Chair. So the energy piece, what percentage of that is renewable energy, and what percentage is the fossil fuel energy?
So in here, we're focused on kind of energy sources. So the renewables power segment would fall under infrastructure. Okay. And for the private market side that we focus on energy, we're primarily looking at decarbonization type strategies. So anything that will either, it could be industrial processes, renewable fuels, anything of that nature, which facilitate the overall transition to a lower carbon economy. So two funds we have done currently. One is focused on decarbonization of industrial processes, which is ARA. And then the other fund is also focused on sort of move towards a lower carbon economy, which is high tech vision. Yeah.
Thank you.
Yeah.
And a question on that same note, is that theme at all permeating any of the agribusiness investments that you are making, since that is also a big component of fossil fuel?
It has
of carbon.
Yeah, it has very much so. So the fund we are actually invested in on the ag business side is Kibis, and they are very focused on their investment thesis is driven by sustainability. Both they do growth equity as well as VC investments, and it's very sustainability driven. And similarly, also on the farmland side, it's more kind of a core holding, but the manager that we ended up investing with, TI and Naveen, is sustainability is kind of core component of their management thesis as well. So on slide 25, we lay out kind of similar transition that Tara had highlighted just for this segment as to how the segment moves from about half split between public and private. And we expect that in the 3 to 5 year range, this kind of model transition, we should get to a primarily private portfolio, potentially by 2027. And similarly on slide 26, we are showing kind of how the spacing could hypothetically or modeling wise work if we get to the 2027 target of a private portfolio. So the next category within real assets is TIPS. TIPS are Treasury inflation protected securities. So these are fixed income instruments that have an inflation hedging component naturally built in, so aligns with the overall category objective. We have a 3% allocation for overall LACERA's fund to TIPS, and the TIPS investments are primarily done through a passive index investment. And to update you on kind of some of the next steps within the real assets categories, we are in the process of an RFP for an emerging manager program. Similar to other asset categories, we expect to implement an emerging manager program within real assets, and that will be managed by an external manager. In the interim, staff has continued to look at emerging manager opportunities on a one-off basis, but as a dedicated program, it'll be established once the RFP process is done and once the board approves the RFP manager.
And that will be on a global basis.
Yes, it'll be on a global basis across all the segments within real assets. And with that, I'll turn it back to Jim.
Thank you, Pushpam. We wanted to conclude the structure review with an evaluation of kind of where we are and where we're going, a summary. So just in terms of what we think has worked in the real assets program, we did observe that in 2022, when we saw a significant equity downturn, real assets were one of the few asset categories that held up well. We think it largely served its role, mainly from the infrastructure and natural resources component of the portfolio, of being inflation sensitive and passing through the higher inflation into additional returns in the portfolio. We also observe that there is a high correlation in the public markets portfolio to general equity markets, in the completion portfolio and infrastructure and natural resources. And that and also the fact that we have considerable TIPS duration in the portfolio, that helped to work against our portfolio objectives of being a diversifier. So when both interest rates and inflation rose over the past few years, the inflation increase, was passed through in the TIPS portfolio, but the higher overall level of interest rates, as measured by duration, actually worked against the objective of being an inflation hedge. In terms of the assessment of the program, we believe we're about. Oh, sorry.
Can I stop here? So going back to the last few comments that you made with regards to not being a diversifier and not dampen the volatility, if I understood you correctly, of the portfolio, right?
Yeah, I think there's two elements. One is just on the equity side, our public market equity portfolio in infrastructure and natural resources. It's designed to be a diversifier, which it did do, but it also has a fairly high beta to just general equity markets. So it is a diversifier. It did work as a diversifier in this market, but in general, it has a high correlation so that it does tend to move with overall markets, over longer time periods.
Gotcha. Thank
you. So in terms of just where we are, we have, as you saw on some of the prior slides, we're about halfway through this public to private transition in this space. We've invested, or we've committed about close to $4 billion in funds and a few $100 million in co-invests. We've also made investments in secondary structures included in the fund commitments. So we believe we're on a good path to accomplish what we've laid out, which is to be fully invested in private in 3 to 5 years. In terms of what's in progress, we do think there's a need to continually review the benchmarks. We'll do that after the strategic asset allocation next year, to make sure that we're getting the exposures that we want to have in this program as we make this transition to private. In terms of ESG, the policy did include adopting the responsible contractor policy for real assets. We're also participating in GRAS more broadly in infrastructure, and those efforts are going to be implemented in the coming year. And then, as Pushpam mentioned, we have the RFP for emerging managers underway. Okay. So to conclude, we have a summary of the guidelines that we're proposing that the committee advance to the full board. These slides, the next 5 slides, are a summary of information that was already provided in this presentation. Some of them are new slides. I guess maybe a couple of other points I wanted to make here is we're also working as a team to standardize kind of the way that we're presenting guidelines in structure reviews. So I think this is the first one that you'll see that is under these new formats. So the way we're laying it out, the green are really the proposed guidelines that we're asking to advance today. The blue are the existing guidelines that are in place. And you'll see this format in other future presentations. So in terms of how this works for real assets, this slide is a summary of the guidelines for the private portfolio, separated by infrastructure and natural resources. On the next slide, we show the guidelines for the other structures that we're using for co-invests and secondaries. We've actually made investments under those structures in our program, and we've incorporated some guidelines there. We're adding a secondary sales guideline. We haven't done any secondary sales in this portfolio. There may be a situation that arises where it might make sense for us to do one, and these are the guidelines that we would use if that situation were to occur. The next one is the public market guidelines. We have 4 columns for each of the 4 different types of portfolios we have in this asset category. And we have a summary here of the guidelines. These are new guidelines in our structure review, though these were already in place. These were the guidelines that we've always had in managing these portfolios. We just hadn't incorporated them in the structure review until this one. And then the last set of guidelines on slide 37, these are the summary of the proposed emerging manager program guidelines that we would put in place with any new emerging manager program manager. So the last slide is slide 38. This is just a summary of everything that we've said. We're trying to reach a 3% allocation in natural resources, a 5% allocation in infrastructure over the next 3 to 5 years. And we intend to do that with both core and closed-ended fund structures, as well as co-invests and secondaries. And that concludes our comments. We're happy to take any questions you have.
Any questions from
Yes.
trustees?
Yeah.
Go ahead,
Through the chair, I would like to invite the consultant. If you can give us an overview of the market and the opportunity set.
So Mark White from Alborn's coming to the podium.
Morning.
They warned me that I might have to come to the podium. I didn't think it would happen.
As long as I'm here, you will have to come forward.
Good.
Okay.
Sing for your dinner.
Okay, Mr. Santos, I'd like you to rephrase the question, please.
Can you give us an overview of the market and the opportunity set in this particular portfolio?
From your peer perspective, or from the market in general?
For the market in general.
Market in general. Okay, well, typically across starting with the natural resources, we're seeing a lot of opportunities starting to emerge in that space because of energy transition. And those are themes that your staff here have touched on. The biggest opportunity set is in looking at the regulatory elements associated with it rather than the economic elements. So basically trying to develop technologies to get ahead of the regulatory environment. That's where we see the best opportunities in natural resources. I would like to comment on to the earlier question about the agricultural assets. Most agricultural assets, even though it is definitely a very large component of CO2 emissions with respect to what we're trying to address here with climate change, most agriculture strategies are trying to improve their processes, realizing it both from a cost and economic perspective, but also in anticipation of a future regulatory environment. So what we see happening with most of the farms is trying to, for example, reduce the utilization of fertilizers. Fertilizer is a big component because of the manufacturing process associated with it and the elements with it. However, it's one of those things when we look at carbon emissions and CO2 that there is going to be a balance trade-off. At the end of the day, the last time I checked, we all still have to eat, so therefore there is going to be a requirement and probably some form of a CO2 emission. Agriculture is one of those areas that we will likely never get to zero simply because of the way biology works in that space. When we look at the other areas that you looked at in natural resources, one of the areas that we had invested in was basically the mining sector, looking at the metals that would be necessary to actually assist in the transitional environment. And if you recall from that board meeting, probably what seems like a few years back, the view was to basically to participate with GPs and managers that were the most ethical in the industry and basically would promote ethical sourcing of the materials that will be essential to transition to a greener future for humanity. Looking at the last element of natural resources, which Pushpanda touched on, the energy transition. One of the things that we've done differently with this portfolio is focusing on managers that wanted to get ahead of energy transition. So we're not really talking about managers that are focusing on, reducing the use of fossil fuels, for example, or something like that. We're looking at managers that are looking at the holistic approach. Let's say carbon sequester will be part of the solution, but also not narrowing that, looking at alternative fuels such as hydrogen or other processes. And one of the other things that comes across with one of the particular GPs is even conservation. That's probably the easiest element that we can look at with respect to energy transition is conservation. How are we actually using the energy that we are? The infrastructure portfolio is still expanding quite well. The broader opportunity set that we see there is almost exponential. To improve and human society, we have to improve basically infrastructure across the board. Everyone's seen the crazy statistics that gets thrown out about how many trillions of dollars were underinvested. That is not going away. That's going to be an essential part of keeping the US and developed economies, or any economy really around the world, competitive. One of the issues that I am concerned about that in the broader, because you do have concerns about certain areas, is infrastructure is actually a finite area. There's only so many international airports, there's only so many shipping terminals, and there's a lot of capital moving into the space. So we're very carefully watching the competitive pressures that we see in the infrastructure area. And one of the trends that we've looked at, and you've seen in your portfolio, is by focusing on core. These are quality assets that we're focusing on the cash flow characteristics, which have performed incredibly well through the crisis that we've had. And then looking at that value added and expanding definition of infrastructure, looking at what's going to be the future infrastructure, if you will, in those opportunity sets. And your team has very much taken an approach to looking at those opportunities. If you had asked me 20 years ago when I was, still new in this area, if someone said telecommunications is going to be a major part of infrastructure in the future, I would have said, yeah, I doubt that. Now it's hard to say what is going to be the next major component of infrastructure in the future, but the GPs that we're looking at are very keen at looking at that. Does that answer your question?
Yes, thank you very much. With regards to the infrastructure, and looking at the emerging markets like Africa and Latin America, what's your view? Is that opportunity there for us? I mean, we do have, I believe, 20% of the portfolio will be, up to 20% will be invested in emerging markets. So if you can give us your professional view on that.
When we're looking at infrastructure in emerging markets, there's two questions to ask. Number one, the developmental aspects of the infrastructure asset and the profitability associated with that particular asset. Number two is the currency risk that we have with that asset. And that's always a big consideration. When we look at where LPs have been burned in the past in emerging markets, it's been because of a lack of understanding of, number one, the regulatory environment that exists in those jurisdictions, and number two, the actual currency risk. Infrastructure assets by their very design are very low risk. So they're not assets that we're looking to generate returns of 25, 30% like we are in private equity. They're supposed to be very low, very stable, but guaranteed, or as close to a guarantee of revenue that you can possibly get. When you throw on a currency that moves 15, 20% on an annual basis, that can often wipe out the expectations on that. So we're very cautious when we look at emerging markets and look for the stabilization of that. The preference is actually finding contracts. You used, Africa, for example. preference there is to find contracts that are priced in US dollars rather than the local currencies.
And some governments in Africa and I believe in Latin America provides a guarantee of a percentage for an LP coming in. Would that dampen the volatility of the currency, or what's your view on that?
It comes to the testing of the regulatory environment. There are entities out there that will guarantee that. Some of the United Nations organizations, sub-organizations will provide certain, guarantees with power developments in Africa, for example. But it still comes down to the regulatory environment that you're looking at enforcing that. So
at the end of the day, especially in Africa, where you have the Francophone countries and the Anglophone countries, they all different rules. So I hear what you're saying. Okay. Thank you very much. Appreciate it.
Chair, can I add a slight
Yes.
addition? So this is the slide for infrastructure specifically. Part of the overarching theme that we've tried to address is when we're looking at infrastructure is stable jurisdictions, stable currencies, exactly for that concern of if you invest in a currency that's very high returning, part of it is that the currency it has a high carry. So let's say the pound, for example, these days even sometimes has a very high carry, 10% plus, but it has a very jumpy currency or a very volatile currency. So sometimes if you're comparing two currencies and we have to bring things back to USD, you try to stay in the currency that's more stable. So especially when you're in core assets that have a lower returning threshold around sort of that 7%. So if you see the geography here, the way we've mapped it out is we actually don't seek the EM. Generally speaking, we have a 0 to 20% allocation to it if necessary, if some of our diversified infrastructure managers have some exposure to it, but it's not something that we're actively seeking out in terms of exposure on the infrastructure side, which is slightly different on natural resources side, where there is a 20% on the non-OECD portion.
Great, thank you. Thank you very much.
if I can add a point to back up that, one of the things that we look at in infrastructure and real assets is we track it by the asset, not by the GP. So if you have an asset in Brazil, we track that asset is in Brazil, even though the GP may be located in downtown Los Angeles.
Australia.
Trustee
Thank you.
Sanchez?
Thank you very much.
Okay, thank you. So I've been listening with sort of general interest as we go forward, sort of in the new era of investing here at LACERA. The structure reviews take on a heightened sense of importance in terms of their role for the board to establish the acceptable risk and kind of strategy that we're going to make. And so what I would suggest, I think that the presentation overall was an excellent overview of the operational activity of executing on our goals. This is sort of a general kind of comment for everybody that as we go forward into, since we've been doing these a certain way and we're going to transition them into doing them another way, some things that I would ask. I think Herman, Trustee Santos, kind of zeroed in on the first thing that I was going to suggest, which is a link to the opportunity set. I think a slide for each of the components would be very helpful, but also an understanding of the risk that we take in each of these areas, because the whole purpose of providing limitations is not to limit the return, it is to limit the risk. And so understanding that risk slide, I think a slide on the opportunity set and a slide on the risk, and that may be a coordinated effort with the consultant. I think that would be very helpful. And I think an overall tie at some point, maybe in the aggregate, not necessarily at the granular level, to our strategic asset allocation would be just sort of helpful to sort of see. I think you put that in generally, but I think those kinds of elements would be incredibly helpful for the trustees to be able to sort of understand and kind of take on board the narrative of what it is that thematically we're going after and what are the risks we take when making such investments, whether those risks are thematic or those risks are operational. And so I think that would be incredibly helpful. Overall, I think it was a fantastic presentation. So it's not a slide on the presentation, but more sort of thinking about how to move forward and make these structure reviews sort of, something that the trustees can engage kind of more directly with, and get us to where we need to go.
Thank you. Okay, any other comments from?
With that in mind, I will make a motion to approve the changes. To recommend that this committee forward with a positive recommendation to the full board for adoption.
Okay,
I'll second.
Linda?
That's fine. Okay. Mr. Jones,
Aye.
Mr. Kelly,
Yes.
Mr. Santos,
Aye,
Mr. Knox.
Aye.
Okay, the motion passes unanimously.
and good job, good presentation, by the way, thank you. That's also, that goes also to the consultant, thank you.
We don't have anything.
Future agendas. And then good of the order. You want to wrap up or save it for the full meeting? Save it for the full meeting. I'm sure there's a couple welcome Ohtani to the Dodgers. Good of the orders we'll see today. From that standpoint, so without further ado, adjournment until chairman. What time would you like this to start?
Okay, we will start at 9